Hello, welcome from Trend Signal, where we review the data and events of the week beginning the 25th of January, the last week in what has been a very turbulent January 2016, the worst start to the new year and the worst January performance to date on record for equity markets at least. Risk on mode, that's very much what happened in the markets last Thursday, Friday. Equities up, bonds down, oil, base metals up, on all those safe haven currencies, the likes of the yen and the Swiss franc down, and those risky commodity resource currencies, the Aussie dollar, the Canadian dollar, and the New Zealand dollar, all recovering somewhat, certainly the Canadian dollar recovering dramatically. Counter trend moves really in many key markets. Oil, mainly the key, partly the key, but also Mario Draghi from the ECB surprised the markets during his press conference last Thursday, suggesting that the ECB might increase monetary stimulus in March. And then following that, rumors circulated that the BOJ will be increasing its own stimulus at its meeting this Friday. And then, of course, we got the Fed, some market participants suggesting that Yellen, the chairperson of the FOMC or the Federal Reserve, may signal a more dovish tone at the FOMC meeting this Wednesday. Just have a look at the numbers last week. FTSE, Dow, S&P, DAX, they all recovered modestly compared to the falls that they have experienced, but the Nikkei still mired in negative territory, falling 188 points last week. Although the yen has since fallen, the persistently strong yen being a real problem for the Nikkei and the exporters suffering as a consequence. Currencies, the euro staged a bit of a fall against the dollar, falling 164 points. Sterling was unchanged as we saw a bit of a rebound in sterling's performance, having been very much hit over the last sort of 6 to 8 weeks, all the way down from $101.52 all the way down to sort of around 141. Dollar yen, that did recover, as I say, about 180 points, about 1.5%. Dollar CAD was the big mover, falling 480 points last week, about just under 3%, as the Bank of Canada refrained from adding additional monetary stimulus. I think the markets were concerned that there was going to be further monetary stimulus, thus weakening the Canadian further. But I think that key dollar CAD level around the 146, 147 level on the long-term charts preventing any further moves. And obviously, oil markets, Brent, significantly stronger, rebounding nearly $3 last week as the market eventually gave way to a significant amount of profit taken. So that was a 10% rally in crude oil. In fact, it happened in both Brent and WTI, the US benchmark. Copper, base metal, that's sort of a good example of where the base metals were going. That rallied 59 ticks, which is approximately 3%. So after sharp falls midweek, equity markets really rallied and rallied solidly, led by US markets, which rallied sharply into Wednesday's close, and as I said, further strength fueled by comments from Mario Draghi, really sparking a bit of short covering in crude oil and general risk-on move as the, well, I say long-awaited, it was pretty much long-awaited correction in the January sell-off took hold. The question now is it a dead cat bounce, or will it be something more than that? Time will only tell. It's no longer a dead cat bounce when it continues to rebound, of course, but that is all after the event. UK markets suffering a little bit. Certainly Mark Carney suggesting that there's unlikely to be a rate rise this year now, which prompted some of the sell-off and then a bit of profit taking as the facts became known. UK markets are struggling a little bit. Of more immediate concern is a report out, I think from Ernst & Young, about the drop in, or the rise, I should say, in profit warnings from listed companies. UK quoted companies have issued 79 profit warnings in the third quarter 2015, and it could be a signal that a recession is looming. Although stock markets generally don't tend to be very good at predicting recessions, or more to the point, they predict more recessions than there actually are recessions. Some WAG economists suggested that the stock markets have predicted 27 of the last 11 or last 8 recessions. So you can see what we mean by that. Let's have a look at the data and events this week to find out what's going on. We've already had the German IFO business climate, measuring the German business sentiment, which has remained quite robust, really. It had a slight decline the previous month, but the market was predicting a further slight decline, but in the end we got a more of a decline than expected, 107.3 from 108.5. We have a number of central bank speakers this week and meetings, etc. But Mario Draghi kicks off the first speech this week on Monday evening to the Deutsche Börse New Year's reception in Frankfurt. And the idea is that perhaps he could clarify some comments from the recent ECB press conference about perhaps further easing in March. And that's something we feel that might actually be discounted a little bit more. Certainly, it gave a significant lift to the markets on Thursday afternoon. So we await to hear what he's got to say there. Tuesday, we then got our own Mark Carney talking, or I should say testifying to the Financial Stability Report before the Treasury Select Committee in London in the Houses of Parliament. Unlikely to make any comments directly about the path of UK interest rates, but unfortunately for him, if he does, people don't seem to put a lot of credibility behind it as he does chop and change his views. He perhaps needs a new PR agent more than anything else. Wednesday, sort of jumping ahead, there are other bits of data coming out, but I'm just looking at the main ones. Crude oil inventories, the markets are particularly sensitive to these. Obviously, that's is affecting a lot of the markets, especially when it falls significantly. It does create waves in the oil markets, and which then have a dramatic effect on equity markets and markets in general. So that's worth waiting around for at 3:30 on Wednesday afternoon. And then we have probably the most important event of the week, the Federal Open Market Committee, the rate setting committee of the Federal Reserve, the US Central Bank. We expect the committee to acknowledge the risks to the economic outlook in the US posed by global events, really, and developments in the financial markets. But I don't think they will rule out a hike in the March meeting. But some economists suggesting perhaps the Federal Reserve might have got it wrong in December. That is very much in hindsight thinking, of course. I think they've reacted in the right way, but time will tell. It depends how quickly the global sort of flux in the market sort of settles down. Next Thursday, on to Thursday, we have one of the first of the 2 GDP releases. This is in the UK. It's called the prelim one. They have 3 releases for the gross domestic product for the UK. That's in the 4th quarter last year. It takes a while to get all the data together, and the first one really only contains about 40% of all the data. We're expecting plus 0.5%, although some economists are suggesting it will be a bit weaker than that. But that is the first reading. The revisions tend to be more accurate in the coming weeks. Markets will react to that data, of course. Then on Friday, jumping ahead, we have the Bank of Japan's monthly policy meeting. Let's just highlight that there. There we go, the Bank of Japan. The Governor, Kuroda, reaffirmed that he wouldn't hesitate to adjust monetary policy if needed. Recent hints from both the central bank and government talked about more stimulus, and I think the markets are really suffering as the yen has rallied, although they're not supposed to focus on exchange rates, of course, but that is a significant drag on the markets as all the exporters have been hit rather badly. The yen has rallied significantly against the dollar, against the euro, and especially against the Chinese yuan. So we expect some sort of a move on Friday. And then finally we have the first reading of the US gross domestic product for the 4th quarter. Like the UK, it has 3 reports, but curiously, the first report is called the advanced report, and then the second report is called the preliminary one. You can work that one out for yourself. But anyway, 3 reports, but we're looking at a number of plus 0.8%, so fairly robust growth. And of course, those sort of figures will have a direct impact on the Fed and their thinking about future rate rises. That's it. Thank you very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.